IT companies face when they try to expand globally. At Fimple, we started to undergo this process ourselves and realized that this matter is very important, not only for our company, but for many of our partners and potentially also for our customers when they grow internationally. It is important to perform a correct planning of the tax and legal issues from the very beginning when companies expand globally and start to create international structures to avoid any complications and necessity to introduce changes going forward. You need to structure your group in the best possible way to avoid overextended tax charges, which might be different in different jurisdictions, and to plan registering the holding structure in a safe and transparent environment, which will be very important for the future investors in your business, as well as to secure intellectual property rights in a company located in a country which is considered reliable for the shareholders and the owners of the business. In addition, it is important to see how and where it is advantageous for the group to hire personnel, definitely considering that more and more companies allow people working remotely from different countries, which is a complicated situation from a company point of view, as well as from the point of view of the personnel. My name is Marina Vandenberg. I represent our esteemed Fimple group, rapidly growing internationally. Fimple is a developer of a core banking system for international institutions. Our aim is to expand this year globally. Especially, we will focus this year on the European markets, Middle East, and different countries in the African continent. To achieve that successfully, we started to create the Fimple's ecosystem, where we operate together with our global partners and community developers, but also with the local partners for regulatory and compliance matters, or for assistance with implementation or maintenance support projects. Up to now, we have about 175 fintech partners and over 90 community developers. Our ecosystem is called Fimple Connects. Its aim is to bring together our partners and developers, as well as our customers, banks, and other financial institutions. To help us navigating into today's subject related to a very complicated issue of the international tax law and legal structuring of international groups, we asked our business partner, who is the expert in this matter, working with us on our project to become our main and the only speaker today. Ladies and gentlemen, let me introduce you to Mikhail Filinov. Mikhail has been working as an international tax consultant for over 25 years, starting in Ernst & Young and continuing in PwC, where he worked for the most of his consulting career, mostly in Russia, but also in Switzerland. For many years, Mikhail was co-leading international tax services in PwC in the Central and Eastern Europe. Therefore, he appears to be one of the most experienced specialists on the matter of group structuring and international taxation. Since recently, Mikhail moved to Dubai, where he started his own private advisory practice. We at Fimple are extremely happy to get Mikhail working on our global group's expansion project at present to assist with our international growth. What we would like to share with our viewers, the experience and knowledge that we obtained from Mikhail, as many of you might be undergoing similar development issues connected to the international expansion of your business. Also, we believe that the growth and development of Fimple is closely connected to the growth and development of our partners and vice versa, considering that we have to cooperate with each other to be able to provide better services to our customers. I would like also to point out that live broadcast of this webinar is appearing on LinkedIn and Twitter, and we encourage our audience to ask any questions about the subject. So, the topic of today's webinar is Tax Guide to Fintech Companies Building International Structures. Ladies and gentlemen, Mikhail, let's begin.
Yeah, hi Marina, and thanks for having me here. Hi everybody, and we have an hour ahead of us, and there is zero chance that within this hour I will be able to tell you what I know from my 25 years of experience in tax. So today we'll concentrate on the logic of tax and just to let you ask proper questions to tax consultants, and to get proper answers. So let's start. So we press the button, and probably you can see the presentation. The topic is definitely, as you saw, tax guide to fintech companies building international structures. And before we go into discussing specific details of tax legislation in every country, I would like to tell you the following. Okay, tax is a legal profession, so you need to read the law. However, before you read the law, that's an economic profession. You have to look at the taxing rights and taxing desires of various countries and to understand who wants to tax you on the whole globe, because you are not the small business in one jurisdiction. You are multi-jurisdictional business. So there are many countries who want to tax you. That's first. And second, all these countries, they have different and various taxes to apply to you. So before you try to get a legal opinion on tax matters, you need to understand who will want to tax you and how they want to tax you. So amazingly enough, we start with a question, which is basically who wants to tax you? And we start with a map.
Okay, and that's it's actually a country of the historical development of a company we start with. So for example, in the case of Fimple, it will be Istanbul or Turkey, where the company historically was created, right?
Right, and the answer is obvious. Definitely this country says, okay, I see you are here, you are in Turkey, you have an office here, you have an intellectual property here, and I would like to tax you because of those things. But also, when you try to run away from my country, I am jealous. I see that I lose tax revenues. So I would love to tax you not only when you do business, but also when you run away from me. So let's remember that that's called exit tax. But that's not the only. Yeah.
If we expand internationally and move our business to other countries, that will be, and then the Turkish tax authorities will follow our movements and our development.
Absolutely. It's a normal and standard question. Whenever you move something out of the country becomes worried. I'm losing the business. I'm losing the future tax. That's why let me tax you today on something which is maybe artificially imputed, but it does exist. That's called exit tax. So let's remember, but let's go to other countries. So first countries is the country where we are born. Turkey in this case, not the only one country. Naturally, you expand and you have.
For example, if we open an office in Poland, where we will hire developers and create a second development office in Europe, that will be also considering taxes that country.
Absolutely. Right. Natural development, you create a second office, you employ people. Why do you go to Poland? Well, because there are plenty of clever people, the labor cost is quite low. Not so low, but it's okay. And so it's like a natural idea. Let's go to Poland. Does Poland want to tax you? Oh, of course, yes, because they see we have a legal entity. You create a legal entity to employ all these developers. And definitely, as Poland, I would like to tax this entity. Well, I do appreciate that the startup, the business, was not born in Poland, so you brought something to Poland, and that's why, okay, I will be satisfied with quite a low margin, because what happens here are only people sitting. There's no intellectual property. That's not the main sales office, just developers. So I want to tax you as Poland, but I will be quite reasonable in terms of the margin that I would want from you.
Okay.
That's second country, second place on the map. So the next one.
That could be where for example, freelancers work. In case of our map, we showed them in Portugal, for example. And definitely in the modern world, when developers can work online remotely, that can be a very vital and real scenario.
Absolutely. You would appreciate that the tax legislation in the current format has been written like in the 80s, probably. But some ideas go back to the beginning of the 20th century. So all those international ideas, they lack idea of remote working. And there was a big COVID was a big impact on all these matters.
Yeah.
So the countries had to do with the remote workers. So some ideas have been created on how to tackle that, but more changes on the way. Today, whenever you have freelancers in some countries, you need to ask every country, like Portugal in our case, do you want to tax me or not? Some countries would say, yeah, because I see that in your business, a freelancer is the same as your own employee. But some countries would
That's
say,
right.
well, no, it's too boring. Anyway, I'm getting quite enough personal context from those guys. And they make their spending in Portugal because they just collecting money from the whole world. They bring it to Portugal and they spend money in the shops and the restaurants. So it's nice for me as Portugal. I will not tax you as a company, but I will tax those individuals, and maybe even with a good rate. In case of Portugal, there is a special tax regime for the freelancers who come and pay tax there. So there's no uniform answer. I think it's like 80% of the countries would say, no, I don't want to tax you. 20% of the countries would say, yeah, I will tax you, even those are freelancers, not your own employees or legal entity.
So we have to consider in advance what tax regime freelancers the country has got. And what about sales support? If we hire salespeople in different countries, for example, let's in this case consider Germany. If we have a couple of people who are performing sales for us in Germany,
okay, for
what will
example,
happen then?
yeah, absolutely. You are a fintech. You want to sit in Munich or in Frankfurt next to the European banks, selling them something. So you got to employ a couple of Germans or the people who live in Germany there, permanently based. So you need to legalize them somehow. You have to create a legal entity, a small one, just for a couple of people who will be like helping the sales to happen. So you will have a legal entity, and Germany would say, of course, I would love to tax this entity because it does exist here in Germany. Because you have to employ the Germans, the German-based people, and that's why I will tax that. What's the margin? Well, okay, you have nothing happening in Germany apart from those two people doing business. Well, they might be quite senior. So it's like significant margin, but the cost base is quite low. It's like salary of a couple of people. So even if you have high margin, it's high margin on a small base, just a couple of people receiving salary and just small of expense. So in percentage, the margin can be high, but overall it can be quite small. And Germany would say, okay, I'm okay, it's fair, because very little happens in my country. I will take very little tax base to tax.
We should not anyway forget about this, that the country will want to consider and tax those operations or those salaries. Okay, and what about a corporate team? If we hire like senior personnel in certain countries, for example, in the UK or in Sweden, if we have senior management in those countries.
Right. Those countries are tricky. Some countries would say, okay, I see that's only one person. There is no difference to a freelancer. But other countries would say, hang on, that's not an ordinary person. That's not a general guy with a computer just making the code. It's a very clever guy who has a title of CEO, CFO, Chief Sales Officer, Chief Development Officer. So many countries will try to impose tax even based on the presence of one single person, saying that this person attracts a lot of margin to that country. So whenever you have someone saying, okay, I will fly every other week to Istanbul for just a couple of days there, and I will be going back doing my business in Stockholm, then you need to be very careful, because sometimes Sweden can say, well, okay, it's enough. I see that you are not just working there, I see that you are working in Stockholm, I will tax you.
Okay, that's very interesting topic, and worth to think about in advance when you hire senior personnel somewhere in the world. What about, for example, servers? If we have in certain countries servers and no personnel, that's also a quite modern and realistic situation. In our case, we showed them in Netherlands. What would happen in that situation?
Yeah, absolutely. And I know that this example took you by surprise. You didn't believe that such thing can happen. But let's imagine you have in the Netherlands, you have a server which really trades on the Dutch stock exchange or the Dutch forex exchange. Well, will the Netherlands try to tax you? On one hand, like old-fashioned rules, they are all linked to presence of people in the territory for the company to be taxed. In this case, you don't have any presence. You don't have people. But we're living in the 21st century. The servers, the robots on the server can think and can take decisions. So in some cases, if you are heavily relying on this artificial intelligence and making decisions, some countries, eventually, definitely all countries, but today, some countries will already say, it's enough, you are above the line, we would want to tax you, even if you have only the service in my country. Definitely, if you are using Google Cloud and it's everywhere, you can't even tell where your files are in which Google server, then definitely it's okay. But in some specific cases, like trading, robot trading in the stock exchange, these may trigger problems. So don't forget about these things. And whenever you hire tax consultants, just tell them that we have servers there. Let them assess the risk. Don't hide this information from them.
Right. And it is indeed, we were taken by surprise by something like that, because you don't consider that you have people there, personnel, so whether you should pay attention to that or not. But thank you very much, Mikhail, for pointing it out, that it's also a very important matter. And as an IT company or software development company, it's very important where IP, intellectual properties, hold. So if we move it also to another country, in our instance in Switzerland, we are considering to move the IP. What will happen then in that country, in that jurisdiction?
Absolutely. The investment bankers come to you and the lawyers come to you saying, well, the IP in Turkey is not well protected. If you want to sell worldwide and attract international investors, and if you want to become a unicorn, just sell the IP today before it's a unicorn. Sell it from Turkey to a good jurisdiction. Let's sell to Switzerland. Of course, then Switzerland will collect all money from the client, because the company which collects money from the client, you can tune it differently, but eventually the company which owns IP, and IP here is not the address, but it's intellectual property, the company which holds and owns the IP will eventually collect money from the customers. So definitely in this case, Switzerland would say, oh yeah, of course, I see you are the main center of the profit. I would expect you to earn a lot, and that's why I would love to tax you. So definitely, IP companies tax. The other thing is there are specific tax regimes to tax it very low, at low rates, and we'll come to that later, because all the countries they are interested in bring to me the IP, and by the way, bring good people. I don't want to see the farmers or the steel workers or whatever, or the construction workers in my country. I would like to see clever IT guys, because they are clever. They don't pollute the air when they do their IT stuff. So I'm, as a country, I'm interested in getting the IT guys from everywhere. So that's why almost all countries, they have specific tax regimes for the IP, and we'll cover that later.
To be careful, farmers and steel workers are very important also for the country. You cannot say that. But we
Absolutely.
are considering, in our case, we are considering indeed IT specialists, and that's an intellectual property which is indeed important for the country to attract. Okay. For the overall structure of the group, it's not only IP, not only intellectual property, but overall holding structure is important. So we can have holding company in another country. In our instance, we consider Luxembourg, for example. What will happen there in that case?
Yeah, you see, the holding company is located, say, in Luxembourg. So Luxembourg thinks, do I want to tax the holding company? And really, there is no profit which is earned by the holding company. Holding company earns really dividend, which has already been earned by the lower tier companies and has already been taxed at their level. So normally, holding company is located in the jurisdiction which says, okay, I file a tax return, but I will exempt everything because I see that it's only dividend, and dividend is coming from the profit which has already been taxed below at the level of Turkey, I don't know, Poland, Germany, etc. As Luxembourg, I'm collecting the profit, but it's after tax profits already. So I will exempt it. That's the way how you choose basically the holding company location.
Okay. And it's, of course, very important to consider all timely and not forget about these important issues to avoid any changes afterwards, which might be necessary.
Absolutely.
What about the markets where we sell? Because we sell to different, or we tend to sell to different countries, different continents, different jurisdictions. Does it matter to which countries we sell, and will there be any taxes there which we may consider to pay?
Yeah, absolutely. So you sell to many countries, like in my case, Saudi, Egypt, Pakistan, India, and France, and a couple of others, Vietnam. Do they want to tax you? The answer is they always think of that. First of all, for big players like Google, there is absolutely different process which is not applicable to you yet, because you are not a super top 10 countries in top 10 companies in the world in the IT sphere. But those countries,
We are going to be, Mikhail. We are going to be.
Not yet. That's why.
That's our intention. Okay.
So for super big companies, there are special rules which basically force, I don't know, Google, Apple to allocate their profit among all the countries where they operate. Special rules, it's specific discussion with specific companies, more or less this way. For normal companies, say, I don't know, Egyptians,
Right.
tax authorities, they see Egyptian bank paying fees to a startup, I don't know, to Luxembourg, to Switzerland, for example, in our case, because that's the where IP sits. So Egypt says, okay, well, in some sense, the country of state of Egypt, I let you earn from my companies, because I have created the economic structure. I take care of the monetary circulation, tax system, legal protection. Just you are exploiting Egypt by sending the IP there and getting money from Egypt. So I want to tax you. However, Egypt says, okay, but then the price for the software will go up by this tax. So maybe I don't introduce this tax. So the answer is, some countries do treat royalties for software as something which is subject to withholding tax. And some countries don't, they say, no, I will not tax this, because I know that effectively that's increase of price for my customers in my country. Okay. So whenever you sell something to some country, please ask what's the legal type of the income you are earning. Is it called sale of royalty or sale of IP software, or it's called royalties? And then you need to ask the local legislation, do you impose withholding tax on that or not? You don't need to be registered. It's just the Egyptian bank, when paying you 100, it will pay you 80 and withhold 20 and pay 20 on your behalf to the tax authorities in Egypt. So this is how more or less it works.
And will it be called royalty or sale of software? It will be. It will depend on jurisdiction where we sell, or we have to decide ourselves how we call it.
Well,
if you understand what I mean.
Well, the jurisdiction gives you the rules how to read your sales contract. So take your sales contract, read it with the eyes of the tax authorities of the specific countries, and understand what your income, how it is called in that country. And then you have an answer how it's taxed. So it's like this way. By changing the contract, sometimes you can flex the type of the legal type of the income you are earning. So it's something which is part of the planning.
So before selling to any new country, we have to consider how it will be treated and whether they will want to collect withholding tax from our customer or not. And that means we would, if they do collect withholding tax, then we would be paid less, in fact, by the customer.
Correct. You will if the net is the gross payment is 100 and the tax rate is 20 withholding tax rate, you will get 80, and I on your behalf will take away 20 from the budget, from the payment, and remit it to the tax authorities in Egypt in my case, or India or Saudi, whatever, in France.
Okay. And that's, of course, very important to understand in advance.
Yes, absolutely.
Right.
So we basically are done with the globe. We've placed on the map all the countries which would want to tax you. And that's first step that you need to ask yourself, who wants to tax us on the whole map, on the whole globe? Before you answer those questions to yourself, don't even try to ask the tax authorities, the tax advisors. They will basically give you a wrong answer. They need to be told the complete picture. We need to be quick because to fit into our schedule. So let's go to the next question. And the next question is really, we know who wants to tax you. The second question is how they want to tax you. What are the taxes to be paid? And definitely we start with an easy question, which is corporate income tax. Corporate income tax is very easy. You just have your profit. Profit is income less expenses. All whatever you earned in between is yours, and that's profit, which is taxed with corporate income tax.
And that's in your historical jurisdiction in the main company where you have
in any jurisdiction where you have a legal entity, you will pay this tax. Second is definitely don't forget about personal income tax. It's not your tax. It's not the company's tax. It's the employee's tax. But it matters. You need to understand how your people, your team will be taxed and what tax they will pay. And don't forget,
No, it can be probably different in different countries. The tax on salaries, it's either the company pays, or in certain countries, individuals have to pay themselves, or not.
Well, tax on salary is normally paid by the individual. It can be technically withheld from payment. So like your employer pay you 100, but I withhold 10 and I will give you 90 and 10 on your behalf to the tax authorities. That's again withholding of personal income tax, but it's you need to understand the rules and the processes. But don't forget that you not only paying salaries, but you also make people, the stakeholders, employee stock option plan or something like this. So you have to give them stock options or whatever, and this is also taxable. You need to understand when and how this will be taxed. And a very close thing to personal income tax is really the social taxes, because they are as well paid on normally on salaries. You'd better structure your employee stock option plan so that the social taxes don't apply to that. But sometimes you can't really, and you need to pay social taxes on the ESOP as well.
And social insurance, pension fund, these things.
Yes, that's all social taxes. They may be absolutely different in
yeah. Okay.
Value-added tax.
Value-added tax.
Well, normally the value-added tax is just a passed-on tax to the next customer. So it just not you are paying value-added tax, but you invoice the whole amount to your client, and the client pays you, and you just give that money to the state tax authorities. The problem is,
and it's recovered normally.
It's that's called it's recovery of VAT. However, the problem is specific, very typical problem for the startups who are dealing with the banks, is that banks, they are not paying VAT almost anywhere in the world, and they may face the problem that the invoice, when you invoice to a bank 120, which is 100 plus 20 of VAT, this 20 is basically lost for them. It basically increases your price for them. Well, you can't avoid that. Everybody is in this situation. So it's not like your structure is bad and you have a VAT leakage by selling to this bank. Everybody who is selling to that bank, they have the same issue. It's just need to understand that, but you can't really plan around that. There's very little tax planning that you can do, because that's a specific of your customer. If your customer is a bank who cannot recover the
and that's exactly our situation. We work with banks and financial institutions.
Absolutely, yeah. Right. So CFC tax, corporate income tax is you earn something and you have expenses. The difference is taxable with the corporate income tax because that's profit that you have. Sometimes you have controlled foreign corporations tax, which is in a holding company country. The countries say, okay, I see my holding shares in low taxed companies. I would like, as a holding company jurisdiction, I would like to tax these entities, these legal entities, these companies, which are not in my country, they are elsewhere in an offshore, but I would like to tax them because they belong to my company, which is a holding company of the group. That's called CFC tax, and you need to be very careful, because if you have a good company, like in Turkey, which enjoys zero because you do business in a specific technopark or whatever, then improper choice of the holding company may basically wipe out all the tax saving, because the holding company would say, oh, well, it's an offshore, it's zero, I would like to tax this profit. It looks like it doesn't make sense. In fact, it does. The whole tax reform is going this way. So don't use offshores. There would be no offshores in 15 years from now. That's something you need to be worried about, and you need to ask your tax advisor, did you check the CFC taxation at the level of the holding company or not? And the answer should be absolutely yes, we made sure it does not apply, or blah, blah, blah. They need to answer.
Good. So controlled foreign corporation tax.
Yes. Well, it's like CFC tax. It can be labeled corporate income tax sometimes, but it's like subsection, specific section of which is called CFC tax. Tell CFC tax to your tax advisors; they would understand. Another, again, we have corporate income tax. And this is because sometimes you think I'm not paying tax because I'm a technopark in Turkey. But you may have something unusual, like unusual income. For example, in a specific case for Turkey is revaluation. Lira is going down, dollar is going up, so you have an profit because you hold bucks on your bank account. you didn't earn any more money, but it's optically for the tax computation, that's income. So you need to be very careful, and you need to watch for those unusual items of income, because these will be also taxable with corporate income tax. Very, very careful, and especially with the forex up and down. That's a huge problem for everybody.
That's definitely relevant, indeed. That's exactly the tax we're paying in Turkey at the moment.
Absolutely, I know. When I was a student, the refinancing rate and the like devaluation of dollar was like 150% per year normally. I remember still those days.
It can be very high indeed.
Yeah, so I remember those days in Russia and how the tax came out of nowhere. So definitely, I have a lot of sympathy to this case. Withholding tax on royalties. As we said, the countries which are the countries of the markets, they may impose withholding tax on royalties, on gross royalties. They don't care what's your expenses. You may be negative, you may be loss-making as a company, but the country of the market says, I don't know how to look for your expenses. I will try to impose withholding tax gross on royalties. I don't care. Maybe my customer pays you 100 and your cost is 200. You will never ever pay corporate tax because you are loss making. But withholding tax will rise because what they see is 100 of income, and this is on income, not on the profit. It's on the gross, on the payment. You need to be very careful with that. Then exit tax. Again, as we said, it's again corporate income tax. Whenever you leave a country, the country will be jealous. They will say, you are taking away something valuable from me, and I would like to have tax today and now, because from now on, I will not have any future tax income, tax revenues. That's why, as a country who sees someone's going, I would like to tax you. So that's exit tax.
And we are talking here about intellectual property exiting the country. Okay.
Well, some countries can go further, and they will try to tax to impose exit tax on the sale, deemed sale of teams of people. So if the whole team like resigns in one country, goes to another country, and then employed there, sophisticated country can say, well, I see that you basically sold all those 20 guys. You cannot sell people, hopefully today in the modern world, but it's like kind of that. So you've sold the team spirit, the intellect, the intangible asset. I would like to tax you because I see those people gone. And finally, we have withholding tax on dividends. After you are super experienced and super successful startup, you will get a lot of profit and you will start paying dividend to your shareholders. Sometimes some countries will try to impose withholding tax by saying, okay, whenever you pay to an individual in Sri Lanka, in Germany, or in the US, I will impose withholding tax. You need to be careful. You need to plan about that. But for many cases, it's like something which will happen in 10 years' time or in 5 years when you become really profitable and you have something to distribute. Because normally the startups, they start with, give me money, not take my money. Okay. So we are done with this, with who wants to tax you and what legal instruments they have. So you will have that presentation. So we will see, as a reminder, what kind of thinking you need to have behind your structure. And now a very specific thing. As I said, corporate income tax, there are plenty of exemptions for software companies, for example. They are all interested, come to me, create good workplaces in my country. I will tax you not at high rate, but I will give you huge discount. So there are tax exemptions, and some of them are very easy. Create a company and you will get zero. Fine. But in some countries, they will go further and they say, no, I don't want simply to have a fake company with no people. I would like to see you really coming to my country. Like EU countries do that. And that's why there is so-called Nexus ratio, which is basically an instrument, a legal formula, mathematical formula, which basically
looks very complicated.
It's very easy. It forces you to come and to really to bring people. So the formula above, you have all good costs. What are the good costs? Okay, third-party costs, you can't control them. Okay, that they are good. They are not manipulated. But labor, if I am Luxembourg, I would like you to move not only IP from Turkey to Luxembourg, but I would like also to see people coming from Turkey to Luxembourg, because I would like to see the workplaces created in Luxembourg for IT guys. Or you can create places and hire local guys in Luxembourg.
Yeah.
These are costs. So above you have labor cost in my country, in Luxembourg, and third-party cost. What do you have below? All costs. So labor cost in Luxembourg, labor cost in Turkey, third-party cost, and cost of acquisition, whatever Luxembourg paid to Turkey for the acquisition of the IP. So it's total cost. So basically, this ratio gives you flavor how many good for Luxembourg costs you have in total costs of your business. And sometimes you have a multiplicator 1.3. It's just little, oh, okay, I will give you a little bit more to this ratio because I'm generous as Luxembourg or another EU country.
So for us, it's better to have Nexus ratio higher than rather than lower.
If you are
because it impacts on your tax rates, which you pay in that country, in Luxembourg or wherever the IP holding company is.
It's a simplified approach. In every country implements this idea slightly differently, but this is called modified Nexus approach. It has been invented a couple of 10 years ago, probably, and it's applied universally on the whole globe. And that's very, very clever idea how really to make sure you really came to me. Imagine you create a company in Luxembourg, you are just two Luxembourg people creating a startup and you hire local people. Your Nexus ratio will be 1.3. It's basically kept to 1, but it's going to be 1 because
you don't pay tax. Well, your tax is minimum.
You pay the minimum acceptable. In the case of Luxembourg, it's going to be 1/5 of the headline tax rate, so it's going to be something like 5-6%, something like this. But the maximum saving is achieved because you don't have labor cost in other countries. You simply everybody is in Luxembourg. Cost of acquisition of IP from another country. Well, you don't acquire, you create the IP in Luxembourg. So this ratio will give you maximum, and you will get the lowest tax rate. On the other hand, if you have nobody in Luxembourg and you have basically very little third-party costs, so Luxembourg says, okay, why do I favor you? Why do I give you a reduced tax rate? I don't like you, basically. You just artificially created a company in Luxembourg, you've moved the IP here, and because of companies like you, me, I am Luxembourg, I'm blamed on the whole world as a tax haven. I don't want to be blamed like this. I would like really to be a good country for good people to come and to do business with me. That's why it's a geopolitical thing. All the countries, they would like to attract new business, but they don't want to be seen as tax havens, which are blamed by by the left-wing journalists, by the even right-wing journalists. You need to think of that.
They want to have real people also in their country working and developing that software or that working on the intellectual property, not just the title.
Absolutely, yeah, and that's the main thing you need to take out. Assess yourself who wants to tax you. Just feel which companies would have legal or moral rights to tax you on the whole globe. That's first, what you need to do. Second, you need to understand what legal instruments there are in each country, what are taxes, what they are legally called in every country, and then you need to understand the logic behind these, for example, exemptions. The logic behind Nexus exemption is very clear. As a country, which introduces this, I would like to force you to bring people, real business to me. That's what I want to achieve, and that's why I introduced this sophisticated. If you play a little bit in your head with the figures, after all, we are talking to the software people, and they are clever in math, probably. So just play in your head with this formula, and you will see that what it really stimulates. It stimulates business in this specific country.
Yeah, what I can also see from this formula that the thing what you can play a little bit about is cost of acquisition of the IP. Labor cost is labor cost. That's what you pay either in the holding company or in the other development companies. But cost of acquisition of IP, you can of intellectual property, you can play a little bit. You can sell it cheaper, more expensive. So, to what extent does it? Can you change it?
I don't like the word play, because play sounds like artificial. You don't play with the tax authorities.
Okay.
The cost of acquisition is something which is factual, basically. If today you are a startup in Turkey, you want to jump to a new structure which will be Luxembourg-based. Okay, it's a factual thing. What's the fair market value of your IP today? You can hire a valuator, and the appraiser will tell you your IP today is $50 million. So that's the reality. That's you need to take into account. But with labor, and by the way, it's not labor only. It's like labor and office, and for example, buying computers. I call it labor because it's mainly related to people in this industry. But it's like, if you go to real definition, it will not say labor cost. Definitely, it's a simplified for explanation. So, but you can play with that in a good sense, by really hiring more or less people in various jurisdictions. Like, it's your decision where to hire. It's manageable. And the cost of IP, you can't manage it. It's a fact. But where to hire people, you can do that. It's your decision. So this is how normally the IT companies, they figure out their future tax strategy, by thinking of where to locate which people.
That means that, okay, we are not playing with the market value, but we can consider it sooner or later moving the intellectual property. So if we just started and we decide to move, then the value will be lower than when we developed it to a very valuable software with high value, and then decide to move. That can be also the difference.
Absolutely. And in the startups, you can see you are not a mining company or like, I know, retail company. You are a startup. Your fair value goes up and down very quickly. Imagine the value of the Beatles brand in January 1, 1963, and on January 1, 1964. In the beginning of the year, zero. In the end of the year, everybody in the whole world know what's that. So in the IT industry, that's the same. You do a couple of good products and your value immediately skyrockets. So don't lose proper time. If you want to change something in your pattern, better do it before you are famous, because otherwise you will be taxed on this exit tax very, very heavily. And
that's good advice.
Well, think of that. I'm a country. I have a unicorn born in my country, and over a sudden this unicorn runs away. I want to stop it at all price. So, but if it's like a small creature before it becomes a unicorn, well, okay, we'll let you go. Always think about taxes as desire and reason to tax someone, it's not a legal profession, it's an economic profession first, and then definitely you need to go or legal definitions and the legal wording, however tax is introduced. Okay, so we are done basically with the theory. We will not bother you with the theoretical things. Now we come, you are clever, you are absolutely know everything, you feel, and your heart is understanding the whole concept of taxation. Now you need to get a legal opinion from tax people. First of all, short one slide on how do you really talk to tax consultants. I'm a tax consultant, and I hope I will retire tax consultant. How do I value my services? I need to analyze the structure. So I need how many hours I put into this. And if you give me 2 options to consider, it will be twice as much hours as I need to analyze that. If you give me 4 options, it's going to be 4 times more. Sometimes I see the clients thinking, okay, well, it's minor. Let's include this country as well. Yeah, are you prepared to pay as much money as you pay for the main option? Because, well, it's just a side option. Maybe no, maybe in the hypothetical case. But for me, for a tax advisor, that's the same money, same amount of hours I need to spend on that jurisdiction as I need to spend on your main option. So be careful when wishing how many options you want to consider with your tax consultant. And also, tax consultant, I'm afraid that I'm starting to do something, and then over a sudden, after interviewing you in depth, after I start my project, there are so many new details and new countries involved that it's like unclear RFPs, RFP request for proposal, unclear description, squared. It's not simply, it's squared, because I'm afraid that I commit to do something for the fixed amount of money, but then you involve this and that jurisdiction, and over a sudden you say, and by the way, our CFO lives in Sweden. And I say, okay, I need to invest a lot of time in this specific thing. So as a tax consultant, when making the pricing for my project, I'm very sensitive, and everybody is very sensitive to the unclear RFP. And also, all tax consultants are extremely sensitive to risks. If you say, okay, and by the way, we'll be using your tax advice to show to anybody in the whole world, attracting them as investors. Well, that's risk cubed. Even how you can figure it out, how much, how big is the impact on the whole taxation, on the whole pricing of the full exercise. Because I'm really sensitive, I would like to talk to you and to take into account your specific circumstances. I'm working for you. If you tell me I will be passing my advice to my friends and they will also rely on that, I'm very, very afraid of that. I don't want to do that, because I work for you. I know your case, like an anecdote. Right. So my friend has the same disease as I am, same cough, same type of coughing. Please, doctor, treat me, but I will tell the same to my friend. No, it doesn't work this way. So please exchange the information between yourself, but don't rely and don't let others rely on the tax advice you get from the tax consultant. So, you found who will be your tax advisor, you negotiated very good fees. What will they give you back? And so the case study. First of all, they need to come back to you with a legal structure. It should be something like this, and I will try even to make it a little bit bigger and ourselves smaller, because you know how we look like. They came up with a picture saying, okay, we have a holding company in Luxembourg, which is owned by investors and the founders. This holding company in Luxembourg, it has as a subsidiary the old main company in Turkey, development company in Poland, the sales support company in Germany, and the IP company in Luxembourg as well. Because it's easier to have one country for many purposes. That's why holding company and the IP company are both in Luxembourg. Luxembourg is a good country. So you all that, and you check that with the lawyers, with the bankers, with HR. Would they be able to find proper people for each location, etc., etc. So you run the with all interested parties. There are zero taxes in here, but now the taxes start to appear. So they tell you what are the money flows, the waterfalls. It looks busy, but it does make sense.
Yeah.
Who pays money?
So these are payments, yeah.
Yeah, the main, we need to figure out how everything starts, and everything starts with the clients. So you see the clients, they are paying the revenue to whom? And definitely to the IP company, because IP company owns the software and it sells the software to the clients. So money are collected by the IP company. It can be different. It's just one of the case studies. It's one example. So the IP company collects the money. Okay, what does this company, IP company Luxembourg, does with this money? Well, it needs to be paying the old main company in Turkey, because at some point of time, it was buying the IP, the program, the software from Turkey. Probably there was no money in this structure before, so Lux couldn't really pay in cash to the Turkish company, so there is a debt. Lux company owes money to Turkey for the IP, which has been acquired from Turkey. So what the Lux company does, it sends money to Turkey as a repayment of debt for selling the IP. Okay, still a lot of money in the IP company. Well, it needs to pay to Polish people. How do you do that? Well, you send money as fee for development to the Polish development company, and the Polish development company pays salaries to the employees. Still a lot of. Well, you pay in the same way fee for sale support to the German company, which pays office expense and salary to two guys who are in Germany, as we remember, in Frankfurt, drinking beer and enjoying time with the banks, selling them your nice software. So
working hard.
Work very, very hard. It's hard to drink beer, I know. They need to be remunerated. It's a little bit, because really you need to cover the expense on a couple of guys' salary and just a little bit of profit to be left in Germany. So still you have a lot of money in the IP company. What do you do with that money? Well, you can invest in future development of the IP, definitely. But if you don't need to develop that, your IP is perfect. You send it up. You send this IP as the remaining cash as dividend to the holding company in Luxembourg, and the same is done by sales support company in Germany, development company in Poland, and the old main company in Turkey. So the holding company accumulates all the free cash, and if it does not need to buy a new team, a new company, new startup, blah blah blah, it simply pays dividend to the founders, to the investors, and the investors buy additional money, additional stakes from the founders. So that's the whole set of cash flows which exist in the structure. So,
but in principle, holding company can be also IP holding, intellectual property holding company. That's right. It doesn't have to be a separate structure.
Yes, if the lawyers are happy with that, and if you choose the same jurisdiction for both functions. It can be the same company, you're right.
Because you have Luxembourg in your example.
Yes, but I have two different companies. One is a specific IP company, which is simply for the IP holding. For example, an investor can try to sue you, the holding company, for something. And if they come to the IP company, that's a problem, because they can try to seize the software. While if it's a holding company, it's much more difficult to stop the business. So separate into separate legal entities. To separate this, it's a great legal tactics and strategy, basically. So sometimes we do that.
That's
Good.
important. That's important to consider as well. That's right. Okay.
Right. Next slide, and we'll also have no tax on that slide, although we are talking about tax case study. So we see dollars,
Yes.
green dollars. They are the margins which are located in each country. So the main margin, the sum of those four figures, is the total profit that you make as a startup when you are profitable. The majority of that is in the Luxembourg company, in the IP company, because even after paying everybody, you still have a lot of residual cash, residual profit, and it's a lot. In the sales support company, tiny dollar, euro. This is because we remember that only two guys are sitting there. So it's like minor profit is allocated to Germany, and Germany says, oh, okay, I see that only two guys, so I'm not jealous. I'm okay with that. A little bit in Poland, more than in Germany, because not 2, but 20 people, but still it's moderate. In Turkey, well, you are born in Turkey, definitely there would always be some people in Turkey, so you are, as a startup, you still keep some presence. So it's a margin in Turkey, it's quite significant more than in Poland, but the majority is in Luxembourg. So you see what the tax base will be in each of those companies' tax return filed in their local jurisdictions. And only then you ask what's the applicable tax rate. And for example, you see that in Germany, you can't apply any exemptions. 31% south of Germany is something like this. But who cares? It's a high tax rate, but who cares? The profit is small. Development company in Poland, you can't employ, for example, any tax exemptions, and you pay full tax rate. Again, high tax rate. Not a big problem because the margin is small. Turkey, you either pay 20 or 25 or 0, whether you qualify for zero tax regime in Turkey or not, but still you pay very little. But the majority of profit is in Luxembourg. And you in Luxembourg, you apply your Nexus approach, you compute this formula, you see how many people are in Luxembourg, how many people are elsewhere, and you see that the effective tax rate in Luxembourg is 9.283, whatever. It's like really multiplying by this factor. And you are happy because you see that all the countries are happy with the amount of margin allocated to those countries. And all those countries, they tell you what's their tax rate. Some give you exemptions, some don't, like Germany and Poland in my case. But the main country where you allocated a lot of margin, this country, Luxembourg in my case, says, I will give you 9.3 because I like you, you brought people to me, you have presence. That's why I will tax you low. So effective tax rate, you just multiply one by another, you sum it up, and you see that your effective tax rate in this case would be something like, I don't know, 11%. And you say, I'm happy. By the way, when you become a business with more than 750 million euro sales worldwide, most probably you will be required to pay at least 15% tax, because that's a modern tax reform which is now on the way. The Pillar 2, so-called, you may have heard that. Everybody who is earning more than €750 million, they will be subject to this requirement to pay at least 15% tax. So,
and that's in which jurisdictions?
Sorry?
In which jurisdictions is that for?
It's totally different topic. Like a small webinar on Pillar 2 normally lasts for 3 hours. You know.
Okay.
Let's forget about that. We are not such big. We don't have such big sales today. Here you have.
Going to.
Of course. But everything is developing so quickly that probably in 5 years' time, the tax legislation will be once again different. So my profession is basically I have enough changes on the way until my retirement in 20 years or 15 years. Okay, coming back to this picture, we see mind withholding tax, because sometimes it's not withholding tax, it's a payment tax. So you need to be very careful that all those payments of royalties or dividends, you need to understand whether there is withholding tax on that or not. So that is it. That is how you analyze yourself. So again, coming back, take the real model of the Earth, the globe. Just place the dots wherever you have presence. Understand and feel which countries want to tax you. After that, understand what type of taxes will be applicable to you: withholding taxes, CFC tax, etc. Then ask properly your tax advisors and expect the tax advisors to give you the legal structure, which is coordinated with the legal advisors, HR advisors, investment bankers, or whoever else.
Yeah.
And then the chart of the cash flows within the structure, and then the allocation of the margin among the companies and countries, and then finally the tax rate in each country. So that's how you measure, how you understand yourself.
Basically, go early enough to the tax lawyer or tax advisor and start to structure and plan in advance. And that's what our company, our group faced ourselves, and that's why we wanted to share it with our audience that they realize that these issues are very important and start to plan themselves timely. Mikhail and our audience, I would like to remind that our webinar is being recorded, and you will be able to revisit it after we have finished with this broadcast. I wish all the best to Mikhail and to ourselves, and also to our audience, who I hope now will be aware of these tax and legal issues, which has to be timely planned. Okay. Thank you very much.
Thank you, Marina. Thank you very much, the audience. Thank you, Kenan. You organized it very, very well. It worked fine. So thank you for you as well. And if you have any questions, ask us. We'll be happy to help you.
Yes. Okay. Bye-bye.
Bye.